Let's start with the basics. What exactly are interest rates? In simple terms, interest rates represent the cost of borrowing money or the reward for saving it. When you take out a loan, you pay interest to the lender. When you deposit money in a savings account, the bank pays you interest. These rates are set by central banks and financial institutions, and they play a crucial role in the economy. Understanding how they work is the first step to grasping their impact on everything from personal finance to global markets. Central banks like the Federal Reserve in the United States are responsible for setting the benchmark interest rates in their countries. These rates influence how much it costs for banks to borrow money from each other, which in turn affects the rates offered to consumers and businesses. By adjusting these rates, central banks aim to control inflation, encourage economic growth, or cool down an overheating economy. Their decisions have a ripple effect, impacting everything from mortgages to credit cards. When interest rates rise, borrowing money becomes more expensive. This means higher monthly payments for things like mortgages, car loans, and credit cards. As a result, people and businesses may think twice before taking on new debt. On the other hand, when rates are low, loans are cheaper, encouraging more borrowing and spending. This dynamic is a key tool for managing economic activity, as it directly influences how much money is circulating in the economy. Interest rates don't just affect borrowers, they also impact savers and investors. When rates are high, savings accounts and fixed income investments like bonds offer better returns. This encourages people to save more. Conversely, when rates are low, the returns on savings decrease, which might push people to invest in riskier assets like stocks in search of higher returns. This balance between saving and investing is a major driver of financial market. One of the main reasons central banks adjust interest rates is to manage inflation. Inflation is the rise in prices over time, which can erode purchasing power. By raising interest rates, central banks make borrowing more expensive and saving more attractive, which can slow down spending and help keep inflation in check. If inflation is too low, they might lower rates to encourage more economic activity. This delicate balance is at the heart of monetary policy. Interest rates have a significant effect on the housing market. When rates are low, mortgages become more affordable, which can lead to increased demand for homes and rising property prices. On the flip side, higher rates make monthly payments more expensive, potentially cooling off the market as fewer people can afford to buy. This is why changes in interest rates often make headlines in the real estate world. Businesses closely watch interest rates when making investment decisions. Lower rates mean it's cheaper to finance new projects, expand operations, or hire more staff. This can lead to job creation and economic growth. However, when rates rise, borrowing costs increase, which may cause companies to delay or scale back their plans. This sensitivity to interest rates is a key reason why central bank policies are so influential. Interest rates also shape how consumers spend their money. When borrowing is cheap, people are more likely to finance big purchases like cars, appliances, or vacations. This increased spending can boost economic growth. On the other hand, higher rates may lead consumers to cut back, saving more and spending less. These shifts in consumer behavior can have a ripple effect throughout the economy. Stock market is highly sensitive to changes in interest rates. When rates are low, investors often seek higher returns in stocks, driving up prices. Conversely, rising rates can make bonds and savings accounts more attractive, leading some investors to shift away from stocks. This can cause volatility in the markets as traders react to every hint of a rate change from central banks. Interest rates also influence currency values. Higher rates tend to attract foreign investors looking for better returns, which can strengthen a country's currency. A stronger currency makes imports cheaper but can make exports more expensive for other countries. On the other hand, lower rates can weaken a currency, making exports more competitive but raising the cost of imports. This is why interest rate decisions are closely watched by global markets. Bonds are especially sensitive to interest rate changes. When rates rise, existing bonds with lower yields become less attractive, causing their prices to fall. Conversely, when rates drop, older bonds with higher yields become more valuable. This inverse relationship is key for investors to understand, as it affects the value of their portfolios and the overall health of the bond market. For governments, businesses, and individuals, the cost of servicing debt is directly tied to interest rates. When rates rise, debt payments become more expensive, which can strain budgets and limit spending on other priorities. This is especially important for countries with large national debts, as even small rate increases can have significant budgetary impacts. Interest rate changes in major economies like the United States can have global repercussions. When the Federal Reserve raises rates, it can attract capital from around the world, affecting exchange rates and investment flows in other countries. Emerging markets, in particular, may feel the pressure as investors move their money to seek higher returns in safer markets. Interest rates tend to move in cycles, rising and falling in response to economic conditions. Central banks may raise rates to cool off inflation during a boom, then lower them to stimulate growth during a slowdown. Understanding these cycles can help consumers and investors make better decisions about borrowing, saving, and investing. Interest rates play a big role in personal finance planning. Whether you're considering a mortgage, car loan, or even a credit card, the rate you pay can make a huge difference over time. Keeping an eye on interest rate trends can help you make smarter decisions about when to borrow, when to refinance, and how to manage your savings. Credit card interest rates are typically higher than other types of loans, and they can change quickly in response to central bank moves. If rates go up, carrying a balance on your card becomes more expensive. That's why it's important to pay attention to rate changes and manage credit card debt carefully. For many students and families, interest rates on student loans are a major concern. Federal student loan rates are set by the government, while private loan rates can vary with market conditions. Even small changes in rates can add up to thousands of dollars over the life of a loan, making it important to understand how rates are determined and how they might change. Buying a car often means taking out an auto loan, and the interest rate you get can make a big difference in your monthly payment. When rates are low, it's easier to afford a new vehicle. But when rates rise, you might need to look for a less expensive car or negotiate harder for a better deal. Understanding how rates affect auto loans can help you save money. Mortgages are often the largest loan most people ever take. The interest rate on your mortgage determines how much you'll pay each month and over the life of the loan. Fixed-rate mortgages lock in your rate, while adjustable-rate mortgages can change with market conditions. Knowing how rates work can help you choose the right mortgage for your needs. When interest rates fall, many people consider refinancing their loans to lock in a lower rate. This can save a significant amount of money over time, especially with large loans like mortgages. However, refinancing isn't always the right move, as there can be fees and other costs involved. It's important to weigh the benefits against the costs before making a decision. Interest rates can also impact your retirement plans. If you rely on fixed-income investments like bonds, rising rates can increase your returns, but falling rates can reduce your income. Planning for these changes is crucial to ensure a comfortable retirement, especially as rates can fluctuate over time. Small businesses often depend on loans to grow and operate. Interest rates determine how affordable these loans are. When rates are low, it's easier for small businesses to expand, hire, and invest in new equipment. Higher rates can make it harder to access capital, slowing growth and innovation in the small business sector. Expectations about future inflation can influence interest rates today. If investors believe inflation will rise, they may demand higher rates to compensate for the loss of purchasing power. Central banks also consider inflation expectations when setting policy, aiming to keep them stable to avoid economic shocks. Yield curve is a graph that shows the relationship between interest rates and the maturity of debt. A normal yield curve slopes upward, meaning longer-term loans have higher rates. An inverted yield curve, where short-term rates are higher, can signal a coming recession. Investors and economists watch the yield curve closely for clues about the economy's future direction. Interest rates can influence job creation and unemployment. Lower rates make it cheaper for businesses to borrow and expand, which can lead to more hiring. Higher rates can slow economic growth, potentially leading to layoffs or slower job growth. This is why central banks consider employment data when making rate decisions. Real estate investors pay close attention to interest rates. Lower rates make it cheaper to finance property purchases, which can drive up demand and prices. Higher rates can cool the market, making it harder to profit from real estate investments. Timing purchases and sales with rate cycles is a key strategy for many investors. Consumer confidence often rises when interest rates are low, as people feel more comfortable borrowing and spending. High rates can make consumers cautious, leading to reduced spending and slower economic growth. Policymakers monitor consumer confidence as a signal of how rate changes are affecting the broader economy. Governments use fiscal and monetary policy to influence interest rates and the economy. Central banks set rates, while governments can use spending and tax policies to support growth or control inflation. The interaction between these policies is complex, but understanding it helps explain why interest rates move the way they do. Technology is changing how interest rates are set and transmitted. Online banks, fintech companies, and digital currencies are creating new ways for people to borrow, save, and invest. These innovations can make rates more competitive and accessible, but they also introduce new risks and challenges for regulators. In summary, interest rates are a powerful force shaping economies, markets, and personal finances. They influence everything from the cost of borrowing to the returns on savings, from housing prices to job creation. By understanding how interest rates work and what drives them, you can make smarter decisions for your financial future and better navigate the ever-changing economic landscape.